Excellent.
Okay, guys, how are you all feeling? Everyone feel good, refreshed, yeah? Anyone need pens or paper or anything like that? No, everyone good. Right. Okay, we've covered off all the boring bits, the making money, that kind of thing, you know, growing portfolios, the kind of slow, uninteresting bits. Now we're going to get onto the real fun stuff, taxation. So I don't know about you guys, but I love paying tax. It's such good value, you know, and we pay such small taxes over here. I mean, come on. It's not like you earn money and pay tax on that and then use that money to buy other things and pay tax on the things you're buying or anything like that, is it? Who in here likes paying tax? Come on, be honest. Anyone heard of the comedian Chris Rock? Yeah? Yeah. Chris Rock has a gag. It's more applicable to employed people. And his gag is, you don't pay tax, they take tax. You get your paycheck. You didn't say, I'm going to pay the government some tax out of this bill. You get your paycheck. The money's gone. They've stolen it. Unfortunately, like you said, the more money you make, the more tax you have to pay. So in some respect, it's a good thing, because if you're making that much money, then you're doing something right. Yeah, a good accountant. Paying tax is inevitable. You have to pay it. What we're going to do is just cover the ways of minimising the tax you pay. So it's not a case of avoid paying tax. It's a case of make sure that the amount of tax you pay is the least you possibly can, okay? So I'm just going to run through the 2 taxes that you are liable for on buy-to-let property and look at some ways of minimising that to keep a little bit more in your pocket and a little bit less from buying cruise missiles or whatever stuff the government decide they're going to use it for. Okay, excellent. 2 taxes then. Anyone want to hazard a guess? Capital gains tax 1? Got them both. 100%. Give yourself a round of applause. Income tax. Basically, any money you earn after a certain threshold is liable for income tax, and then depending on the amount you earn would depend on the banding of tax that you pay on that money. So it can be anything from nothing to 20% or as high as 40%, depending on how lucky or how unlucky you are, eh? On that money, you have to pay that tax. No way you can get around it, not legally anyway. And we'd never encourage anybody to do anything that wasn't legal. It's just one of those things. It's part of the business. Now, basically, income tax is paid twice a year, and it's applied to the profit generated from renting out your property. So it has to be paid every year in half-year instalments. That's on the 31st of January and the 31st of July. Okay, and there's a very simple formula for working out the taxable profit. It is literally, the taxable profit is the taxable rental income minus the allowable expenditure. So taxable rental income, and more importantly, allowable expenditure, we will define that in more detail, so that will easily allow you to calculate and reduce your taxable profit by maximising all allowable expenditure, okay? And then the other one, capital gains tax, you only pay that tax on disposal of a property, and it's essentially the profit, tax on the profit that you've made from selling that property, assuming you've made a profit. Okay? Income tax then, how to maximise allowable expenditure. Now, things you need to remember, any costs you incur for the sole purpose of earning business profit is allowable expenditure, okay? And capital allowances on the wear and tear of things like furniture or buying a capital asset for furnished lettings, okay? So they're the 2 things that you can look to reduce your tax by maximising the expenditure. Now, maximising allowable expenditure, it is defined as any costs you incur wholly, necessarily and exclusively for the business, and that is fully deductible from your rental income, okay? So the 3 key words there, wholly, necessarily and exclusively. To give you an idea of what you may be looking at, any repairs and maintenance costs, they're fully deductible. If you were remodelling your property, that wouldn't be fully deductible, apart from the cost of anything that would have been essential maintenance that you would have had to carry out anyway. Okay? Finance charges, so any cost you incur paying brokers or specialists to raise suitable finance for you, that is a fully deductible expense, okay? Legal and professional fees. Council tax, electricity, water and gas if you're doing a rental that's inclusive of bills, okay? Not if they're exclusive, but if it's inclusive of that, then that is deductible. You're paying that. Any insurances that you take out, that could be your buildings insurance, it could be like maintenance insurance or anything like that, that is a deductible expense. Advertising, any costs you incur to advertise your property, putting ads in newspapers or whatever other methods you use. Property agent, ground rent, service charges, any letting agent's fees, all deductible. And stationery, if you use stationery, if you buy stamps, send out letters, any kind of administration costs like that you incur, that is also fully deductible as well. So there's quite a range of things that you will be paying out for that you can then offset against your profit to minimise the amount of income tax you're going to pay. So more money in your pocket, less in the government, less cruise missiles, more world peace. There you go. Striking your bit for world peace. Now, you can also look to deduct any expenditure that you make relating to the big business. Oh, sorry, I'll just get the door. Come on in. That's okay. So you can also look to deduct any kind of personal expenditure that you make, but only on a kind of percentage basis. So to give you an example, you've got a portfolio of 40 properties, you have a car, you spend 70% of your time out on the road, going around the properties, visiting your tenants, making sure everything's okay. You could offset 70% of the costs you incur, so the cost of fuel, the cost of servicing, maintenance, MOT, insurance, against the taxable profits. It has to be realistic. If you've got one property and you try claiming 70% of your motor expenses, it's not going to fly. Telephone calls, you incur whatever on your telephone bill, and 50% of that is because you're making calls for the purpose of the business. Again, that is deductible, but only on a percentage basis, okay? So you've got to decide what the split is on personal and business use for that. I mean, again, if you use an accountant, they'll be able to advise you on what's realistic based on your own circumstances. Now, maximising allowable expenditure, so capital allowances on the cost of buying a capital asset or a wear and tear allowance for furnished lettings, okay? So you can either charge 25% of the cost of any item used to furnish the property, or you can charge 10% of the rent, okay?